UOB and OCBC just announced their earnings. I would say it is decent with the interest rate peaking and most probably will be cutting. This will definitely be something to take note of when it comes to investing in banks. So let us dive straight into their earnings. For those who are new to UOB Bank, I'm optimistic for UOB ever since the aggressive purchase of the consumer banking business from Citibank in Malaysia, Thailand and Vietnam. Of course, the integration will take time and we should expect their non-interest income to benefit from this. Banks' income are generally categorized into two types of income. The first is interest income and the second is non-interest income. Interest income is dependent on the earnings from the interest of loans. Therefore, this income is very dependent on interest rate. Whereas non-interest rate income are other factors such as card fees, wealth management, etc. With the increasing non-interest income, UOB will not have to worry about the potential decline in interest rate by the Fed. Similarly, for other banks, I'm sure they are trying to increase their non-interest income in the event if their interest income drops. So let us go through their earnings to see the progress. Straight off at their key highlights, total profit was down -5% quarter over quarter, but fee income is up 7% quarter over quarter. The increase in fee income is good because that is the important portion for the non-interest income to increase. Previous quarter fee income only increased by 2% Q over Q. So for this quarter to have a much higher increase is good as the Citibank consumer business purchase is expanding UOB. Non-performing loan, which is NPL, and the CET1 ratio is decent, with CET1 ratio slightly dropping due to dividends being given out, and that is acceptable. However, one important value that they left out of the slides for all banks is the ROE, which is the return of equity. If you go to their financial statement, ROE actually dropped from 13.9% to 13.7% Q over Q. Why ROE is so important is because it determines how efficient the bank is in generating income using the shareholders' money. Although there is a drop, it's still way above the average ROE of all banks in general of 10%. With the possibility of lower interest rate, the ROE might be expected to drop, so we have to observe this closely. Looking at their balance sheet, net interest income did not have much change. The difference maker is the net fee income having a 18% year-over-year on quarter basis and 11% year-over-year on comparison between the first half of 2024 and the first half of 2023. Hopefully, we will continue to see strong growth in this sector as the management has still reinforced that fee income will still continue to be expected to have double-digit growth. Other interest income will always be expected to have fluctuations as it dependent on the performance of their trading income. With Citi consumer business integration still undergoing, net profit comes in lower 4% Q over Q, but is almost the same year over year. Loan margin slightly increased to 2.51% for this quarter, therefore having a higher net interest income. However, if interest rate starts cutting, I expect this net interest income to start coming down, similar for DBS and OCBC. With the good increase in the net fee, it's now 18% of the total income. I expect this to continue increase with the additional customers from the Citi consumer business. Hopefully, it will be able to offset the potential drop in the interest income. Another important parameter to watch for banks is their cost-to-income ratio. It's another way of showing how cost-efficient it is of the bank. For UOB, if we exclude the one-off expenses, it comes in at 41.8%. This is still much higher than OCBC and DBS, which both are at 37%. This meant that their operational cost is less efficient than the other two banks. Hopefully, with the strong growth in their income, we can see this cost-to-income ratio start coming down. NPL is non-performing loans, which are loans that banks is expecting not to get back. For Singapore banks, their NPL is at a very safe level. For UOB, is at a decent level of 1.5%, but it's higher than DBS of 1.1% and OCBC of just 0.9%. With all this, they have announced a dividend of 88 cents per share, which is an increase of 3.5% year over year in dividend. At the current dividend payout ratio of 51%, they are quite comfortable in giving this dividend at this level and maintaining it. Unlike REITs, which must give dividends at 90% payout ratio, banks usually give in the range of 50%, which gives them the potential to grow the company or give potentially higher dividends to shareholders. Now let's go on to the next bank, which is OCBC Bank. Looking at just their key highlight results, they seem to be way better than UOB earnings. Group net profit increased by 9% year over year is good, with total income increasing 7%. Surprisingly, net interest income also increased 3% year over year to new highs, while non-interest income increased by 15%. This is good because even with the net interest margin coming down, they are able to bring up their interest income. This can be done usually with higher loans taken by customer, which can be seen with customer loans increasing 2% year over year. Dividend increased by 4 cents year over year, which equates to an increase of 7% year over year. Earnings per share and return of equity also both came in higher. The increase in ROE year over year is always good at 14.5%. But if we compare it Q over Q, it's a drop from 14.7%. CET1 ratio is at 15.5% and will be 14.7% after giving out the dividends. With the new increase in dividend, its payout ratio is still only at 50% because of the increase in their income. If we look at the balance sheet for additional information, allowance also decreased by negative 14% year over year. Allowance are usually money set aside by banks as a reserve for their bets. Since OCBC non-performing loan ratio has actually dropped to a new low of 0.9%, that might be the reason why lower allowance is required. With the net interest margin dropping, net interest income is expected to drop. However, so far, it seems like there's only a slight decrease with assets up 15% that help to maintain the overall income. With the purchase of Great Eastern, it allows their profit contribution from Great Eastern to increase. Non-interest income comes in at 32.9% of their group income. For OCBC, there are times where this value will fluctuate due to the inconsistent profits from GEH at times. For me, the net fee and commissions tend to be more consistent. So usually I will take more notice on these two incomes because they will be the reliable source for the non-interest income. With the expansion into overseas market, hopefully we can continue to see good growth in the fee income. Cost to income ratio for OCBC comes in at 37.5% as income growth outgrown the rise in expenses. The lower this value, the better, because this shows how efficient the bank in managing their finances. Overall, if we have a summary for the results of the two banks, we can see the comparison between the key parameters. So far, here is the update of the overview. If we see between UOB and OCBC, the weightage for non-interest income for UOB has dropped from 32% to 30%, whereas for OCBC, it has slightly increased by 0.3%. ROE for both banks have dropped slightly by 0.3% and 0.2% respectively for UOB and OCBC. Non-performing loans for UOB is still higher, slightly higher at 1.5%, while OCBC is at a very good lows of 0.9%. CET1 ratio essentially shows how much money the bank has, and OCBC obviously has more at 14.7% post-dividend or before dividend of 15.5%. UOB has a lower CET1 ratio of 13.4%, but is still above the industrial standards of 10% CET1 ratio. Dividend yields for both banks have increased slightly due to the crash in the share price, and UOB is at 5.85% while OCBC is giving at 6.28%. cost to income ratio of UOB is much higher at 41.8%, while OCBC has slightly ticked up from 37.1% to 37.8%. So with this, we will await for DBS next earnings to see what is the comparison between these three banks. Of course, one risk to take note for all banks now is that if there is a sharp interest rate cut by the Fed, banks' earnings will definitely be heavily affected in the short term. After that, it will be dependent on the banks on whether they want to maintain the dividends or reduce the dividends due to lower income. Like I said, with their current dividend payout ratio only at 50%, banks have the flexibility on how much dividends they want to give. Thank you so much for watching. I hope this video is helpful. If you like it, please support the channel by hitting the like, subscribe, and comment on what are your thoughts on the banks, or if you have any queries that you'd like me to clarify on. Thank you, and I'll see you in the next video.